Hi, everyone. Welcome, welcome, welcome. We are so excited to have Danny Flores here today talking about multifamily. Danny and I can't remember how far we go back, Danny. I know I met you, I think at Bill Tan's meeting, God, back in the 90s probably. And it's been a while. And Danny's just grown and grown and grown and been so successful with his multifamily. We're very honored to have you. And I would expect you are now a family office, so that would be totally cool. So thank you very much for coming and take it away.
Thank you so much for the introduction, Peggy. I'm going to do a share screen. What I did is I prepared a presentation on a deal that we have. I want to talk about how we go on our deals from acquisition to renovations and then to stabilization. And then that way, maybe you guys can see some of the steps we do that has helped us stay successful, basically.
Okay, thanks.
Okay, can you guys see this?
Yes.
Yes.
Okay. Perfect. Okay. So this is an 88 unit deal that we bought back towards the end of 2021. It was an off-market deal that a broker relationship brought to us. They said, do you want this deal? Basically, the sellers at that point said, give us, I think it was at the time, like, give us a 2 cap and we'll sell it. We gave it to them and we were able to buy it. So I want to walk through all the steps we've taken to basically do renovations and to where we're at today with a stabilized building. But before, just real quick, I want to our disclosures, anything that we talk about on this as far as forward-looking projections, no guarantees on what that really looks like, but I do have some actual numbers that I will be able to share what we've done historically on this one. And then the second one is, this is not an offer to invest. When we do that, we do it through our website and our private placement memorandums. Okay, so we're going to go through. I want to tell you a little bit about my background. Tell you a little bit about how we sourced this acquisition. A little bit about how we plan the business plan for renovations and what that looks like. What we've ended up with in the building as far as a stabilized building, and then basically the options that we have to do with the building now that it's completely stabilized. Okay, a little bit about my background. I've been investing in multifamily since 1999 when I bought my first multifamily building. At the time, it was only a 4-unit in the city of Norwalk, California. All these years, California was an easier environment to navigate, but it became more and more difficult. And so we decided to go out of state. About the first 15 years of my investment career were buying with my own money. So I got a chance to see a lot of deals go by that I couldn't buy. I just didn't have enough money to buy. And so I learned how to syndicate over the last 5-6 years. And I think that's when you and I met, Cliff, in 2018 in Boston. So that's when I started in the business and learning it. A little bit background previous to getting into this is I have 16 years in the construction field. I was a builder. I was a general contractor when I was 21. So I know the building industry fairly well. Went from there and went back to school, got into USC, got a finance degree and became a banker. We were syndicating loans between $25 million to over $1 billion, and gave me a really good experience on structuring loans and how to put loans together. So with a construction background and with a finance background, it's been somewhat easier for me to navigate in this industry. And I love what I do, basically.
Right.
Here's a list of the last 9 deals we've done. Total till now, I've done 30 acquisitions and 17 successful exits. Last year, we did 3 exits in Tucson. And you can see where we have an entry point for purchase price and a sales price. So these 3 are the ones that we exited last year and did fairly well for our investors. This is what our org chart looks like. I'm the principal of the company. I have a CFO, Crystal. I have a director of acquisitions, which is Jake. He finds us all our deals. I have a marketing director. She handles our social media and all the advertising that we do when we have deals. And then we have an admin assistant, Mark. We're a small group, but we can cover a lot of territory. We hire third-party property management companies, and we hire contractors and subcontractors to do our renovations. So we don't do it in-house. Okay, so I am going to first show you, this is the video that we had that we used to market the deal. And I think it's a kind of a good way to show you guys what the deal looks like.
Oh, everybody's poolside. Is this what it looked like when you bought it?
Okay, so yeah, so that was the marketing video that we used. Had made for the property to present to the investors at the time when we were raising. It was a $6 million raise on this one. The original name of the building was South Bank Apartments. We rebranded it to Tremezzo on the Lake. And the reason we do that is because not all the ratings online were favorable. So when we rebrand a building, we basically start with a blank canvas. We're making the units nice, and we're usually able to get good ratings and good comments on them. And that helps us with the leasing process as we move forward. So I'm going to show you some exterior pictures of the building before we did anything to it. We had parking, we had covered parking, one for each unit, and we had other parking available as well. Building was in pretty good shape, as you can see. They took pretty good care of it. Roofs were in good condition. And this is basically what it looked like. And you can see some of these numbers are totally different now because it's in the Phoenix area. It was in Tempe. We don't have 17% year-over-year rent growth now, but back in 2021 in June we did. On this building, on this project, we had a projected 19% IRR, 8% cash on cash, and over 2 times equity multiple on this one. We raised $6 million at $100,000 minimums on this one. It is 88 units, 12 1x1s, and 76 2x1s, sitting on a little over 4 acres in Tempe. This is some of the reasons why we like that area, because of the employers that exist. It is close to the university, but not close enough where we have a high concentration of students. We only have maybe 5% of our students, and some of those are working on the graduate degrees. Here's a little bit more on the area. Back then, in Tempe, we still had population growth. I mean, it's still there. It's fairly stable right now. Employers are stable right now. We are seeing some softening in the rents and increases in vacancy. We're doing okay, but we see it within the area. Now, here's our strategy going into the deal. And these are the things that we put together as we're putting the deals together. We used a bridge loan on this one that at the time, we're able to do 75% LTV. They did also cover 100% of our CapEx, but they don't give us that money out of the gate. They help us close the deal. And then what we do with the contractors is we have to fund the contractors and pay their invoices. Then we have to submit a request to the bank, and they reimburse us. They usually send out an inspector and do an inspection, report back to the bank, and then the bank will wire us the money. And that helps us. We did it on a monthly basis. So that helped us get reimbursed and continue paying the contractor as we did the renovations. We spent close to $1.8 million in renovations on this building. We also hire local management. In this case, it's a fairly large management company. They manage over 30,000 units in the Phoenix area, and collectively, nationally, they manage, I think it's over about 170,000 now units under management. So they go across different states, which is really good for us because we have a good relationship with them as we're looking at other deals in other states. We can call them and ask them about the area and what they think about the buildings that we're looking at. As far as the improvements and renovations, we spent over $20,000 a door. Basically, we went in there, took out all the cabinets and basically ripped everything out and started from scratch. New cabinets, countertops, stainless steel appliances. We used plank flooring, two-tone paint. And on this specific deal, we also added washers and dryers. Now, we do everything by the book. So we got permits. I know some operators don't, but we don't. We think it's too risky not to. It costs us maybe an extra 2 months in the process, and maybe an extra $10,000 in getting permits, plans and permits. And so we think it's worth doing it that way. And basically, we got inspections on everything, and we won't have any issues the day we decide to sell it regarding that. And then the other part of this deal or any other deal is what's our time frame. This one we have a 5 to 7 year target, but in some cases the markets will allow us to exit earlier if we can get the price that we want and the return for our investors. In today's market, we don't know where that's going, but so we're still holding it and operating it right now. So here I want to talk a little bit about what we have to think about and what we have to put together as we put our renovation plans together. One, I've talked a little bit about permitting for washers and dryers. In this case, we also had to relocate some of the sub panels in the units were facing the bathrooms. And I guess one of the new codes has that the panels cannot face any water sources, meaning toilets, sinks, or showers. But it wasn't too bad because we were able to basically turn the panels around and have them face the bedroom. So it wasn't like taking the panel apart, put no panels in, wasn't too bad. Also, the dryers that we kind of learned as we're putting it together, there's two sizes of dryers. One that has for a shorter exhaust, because the exhaust has to penetrate the exterior wall so that it can let out the heat of the dryer. In this case, we were over 20 feet, so we had to use a larger dryer, so it has a larger motor to be able to push that exhaust farther down the road. And then we were still on the hangover of COVID. We knew that contractors were having supply constraint issues. Our contractor's a really good contractor, and he was really good about mitigating that, ordering a large amount of cabinets, mirrors, any hardware that he had to order. He ordered a large amount so that he would have enough to stay on schedule. And then I talked a little bit about how the bank reimbursed us on a monthly basis, because that's how we paid our contractor. It worked out really well. I mean, it's kind of tedious, but as long as you do it right and have a good relationship with your bank, usually you don't have a problem with that. At the same time, it is a large loan, so that we did have loan covenants that we had to keep track of. Our occupancy could not drop below 80%, and our debt coverage couldn't be less than 110 to 1. And what we did and how we mitigated that is that we renovated by batches of 8 units. We would give notice of non-renewal to always stay ahead, one batch ahead of the contractor. So the contractor, as he finished one batch, he was able to move to the next. But we also had our leasing team behind, which was critical. They had to be able to lease these units. Most of the time they were pre-leased before they were done. And if we had any straggler units, as we received the batches, they were able to lease it within the time frame that the next batch was being completed. Doing it that way allowed us to maintain a minimum of 80% occupancy. And the other thing that put us in a comfortable position is as we moved through the building and did the renovations, we had the tenants moving in and paying market rent. So our revenue was increasing, and we really didn't have an issue with our debt coverage being below 110. And that covered us for the first 12 months, which covered the renovations. Once the renovations were done, then our debt coverage now has to be at least a 125. And we do have to submit debt coverage certificates to the bank and occupancy certificates every month. And we don't have an issue with that right now. Luckily, we were able to buy it at a good basis and have a good loan to cover that. Here's what basically it looks like during the renovation process. This is a wall where the washers and dryers were installed. So this is the back side of it, and you can see, all the plumbing that they have to do. We have on the left side, we had the kitchen and the living room. We wanted to remove the wall from the kitchen to the living room and we'll make it an open floor concept, but it was a bearing wall, which means it's holding up weight from the story above, and we couldn't. So what we did is basically made a window in the kitchen into the living room, which kind of helped create that concept. Picture on the right side is basically what it looks like after they rip out the existing cabinets. We have a little bit more pictures here. The closet where the washers and dryers went, which is the first picture to the left, we had to relocate the water heater from the right side to the left side so we can have the pocket for the washers and dryers. Picture on the right is basically a picture of the hallway during the renovations. Here's another one on the right side, on the left side, basically where the washer and dryer are going. The one on the right side, you can see where the panel is on the upper right, facing the closet. So that's what it looked like after we got the panels turned around. And here's another picture of the hallway. Here's a picture at the bottom, what it looks like when they cover up the plumbing. They use drywall, they come back and they patch it, and then they texture coat it so that it matches and you'll never see the patch. And then basically all the units had carpeting, and we took it out and put planks. So now I'm going to show you some pictures before and after of the exterior and what that looks like. Picture on the right, on the left is the existing. Picture on the right, what it looks like after we painted it. We went ahead and painted the deck around the pool. We didn't have to replaster the pool, but we put new furniture in so we make it attractive for tenants and for marketing materials as well. Here's another view. Left is existing, and the right side is the new paint job. Now, this is what the building or the unit's interior looked like prior to renovations. The previous seller did take care of the building, so it wasn't beat up, but it was dated. It was dated, and there's no way you can get market rent with the units looking like that. So this is what we took out, and then this is what it looks like completed. Nice. This is the kitchen, all new cabinets, countertops, appliances, the range hood. You got the floor, the plank, the two-tone paint. At the top in the center, you see a square, and basically what it had an old oak wood frame with the covers and the fluorescent lights. So in order to modernize it and keep costs down, all we did was take it out, finish the area, paint it, and added a LED light. It almost looks like a skylight. It came out really good. Here's another angle of the kitchen. This is the bathroom, but this is a picture from the model unit. So we did have one model unit that we used during the entire process. So that we used it for marketing, and when tenants came to look at the building, this is the unit that we showed them, and so they knew what it looked like prior to moving in. This is the eating area in the model unit. This is an empty unit, but basically this is what the finished product looked like. Looking at it from the kitchen from the living room towards the kitchen. Mm-hmm. This is a furnished one of the bedrooms in the model unit. Here's a picture of an empty unit, basically, but it's a completed unit. In the second story, we put carpeting in the bedrooms to try to maintain a little bit of quietness from transferring to the bottom floor. So now I want to talk to you about the results of all this work, because at the end of the day, this is what matters. You're going to put a lot of money into renovating the building, but what's the outcome? First, one of the things that we do fairly well is speed. We bought the building in October of 2021. Exactly 12 months later, we were 100% done with our renovations. We only did 80 of the 88 units. We left 8 of the one-bedroom units not renovated, because we were able to exceed the rent we were getting on those units without renovating them. In other words, the rent was going up fast enough where we're like, why renovate? We're getting the rent we wanted, so we just left them. We left them classic and in good condition. Now they're all rented, but nevertheless, the big thing is that we were able to finish in 12 months flat, so which was really good. That in numbers ends up looking like this. When we bought the building, our average rent was a little over $1,000. As of last month, our average rent is $1,665. That's a 61% increase in rent. In our NOI number is even better, because going in, our NOI was $486,000. Today, our NOI last month actually was over $1 million. That's 109% increase. So it was a phenomenal deal in what we were able to do. part of the contribution to the NOI in addition, and the rent number doesn't show it, is we added RUBS, so utility bill back, we added that. We added a few other charges in there, pet rent and things of the sort. So that all contributes to the NOI, and we're able to control our operating expenses. Everything is on a budget, so our managers, prior to the end of the year, we actually put a budget together for next year, and that's the budget they have to follow. Also being renovated, your repair expenses are kind of cut back because everything's practically new. A little bit about the structure on the loan. Because it was a bridge loan, and we know that's kind of a tough environment in today's market. Going in, our rate was 355. Currently, the rate is 851. But we bought a rate cap back then for $92,000. It's a 1.5% strike, which means we cover the first 1.5% of increase. Anything above that, the rate cap covers it. So our effective interest rate now on our loan is only 5.05%.
For 3 years.
That's good for 3 years. The rate cap covers anything above that. So to date, they've paid us out $332,000, the rate cap. And we've talked to them because we potentially have considered refinancing. And because the rate cap belongs to us, I don't know if you guys knew this, but that's money. You can either sell a rate cap. In this case, the provider was Goldman Sachs, and we've talked to them, and they said, we'll wind you up, basically buy the rate cap from us back. And they would currently, we priced it probably about 3 weeks ago, they would give us $750,000 for it. So they paid $332,000. They'll pay us back $750,000. So that's like for a $92,000 investment, we get about $1 million back.
But
Never.
that doesn't take your loan away, right? You still have your mortgage, right?
No, if you refi to a fixed loan with Fannie or Freddie, you use an agency for that, and you're able to get a fixed portion of it. You don't need the rate cap anymore.
Right, you don't.
So then
you've been on for about 30 minutes so far.
Okay, I'm just about done.
Okay.
Thank you. One last thing, or almost the last thing, is we did such a nice job in the renovations that we got nominated as a finalist for Renovated Community of the Year with the AMA. We didn't win. That was last year. We didn't win. There were 3 finalists. Somebody else won. The cool thing is that we're actually doing a 150 unit building in Phoenix right now. And we've been nominated again this year for that building. So we get another shot at it and see if we can win this time, which would be really cool.
Mm-hmm.
And then the last thing is, okay, the building's stabilized. We have options. Our options are, do we sell, do we refinance, or do we hold? We've got BOVs and at 28, 26, and 22. If I had to guess what the market would pay us, probably be somewhere in between. We're not too eager to sell because we think we can get more, not today, but potentially when interest rates go down. We can also refinance the loan that we have, and the refinance would do a takeout of what we have existing, wouldn't really give us a cash out. So we're still waiting, or we can just hold and continue what we have now. We do have 2 one-year options on the current loan after the 3 years. So we're just waiting. We're waiting to see what the market does. And this is basically it.
Great.
Back to you, Peggy.
All right. Thank you very much, Danny. That was really great. So I have a couple of questions, because I always have a couple of questions. And then I bet Cliff has a couple of questions. So the renovation contractor, You hired this person, but you only got reimbursed. So you had to come up with all the money to do you had to come up with money each month to renovate. Did your
Yes.
contractor take no money to begin with? What did you do
Yeah.
about that?
Yes, so the contractor, yes, so he starts his renovations, he starts the first batch, no money paid to him.
Okay,
A good contractor, you can usually works this way. Me being in the business, I understand the business really well. He
okay,
comes in, he renovates, but he does file all his prelims. Prelims are what he files in case if he doesn't get paid, he'll lien the property.
right.
So it's his guarantee. Goes through, and as we put the contracts together, I asked him, how much time do you need to renovate the batches? Batches were about 8 units at a time. He says, I need 4 weeks. This is okay. You're gonna do it in 4 weeks. Time is money, literally, on this project. And so we put it on the contract that if he wasn't done in 4 weeks, he was gonna pay penalties on a daily basis for each day he was late, which are liquidated damages. So what I did is I calculated what my cost was for every day he's late, meaning daily rent per unit, and
Mhm.
then my interest expense per unit. So I kind of figured out what each unit would cost and came out with an amount. And so he says, okay, I'm good with that, I'll sign. But at the same time, I committed to paying him within 30 days receipt of an invoice. So we both committed to each other. You do this, and this is what I will do for you, because they need money to keep going.
Sure.
So he does the first batch, 30 days, he gives me an invoice, I pay him. But we raised enough money to be able to do this because we knew this was what's going to happen. I pay him. The minute I receive that invoice, I send it to the bank and I say, bank, I need you to reimburse me, call it 200,000. They send out an inspector, they inspect the property, and the inspector reports back to them. They check for liens, and if it clears, then they wire me the money. So I pay him first, I get reimbursed that month. So I'm basically reloaded. Next month, he gives me an invoice. I pay him, get it back from the bank. And we did it that way every 30 days. This is what we did all the way through for 12 months, and it worked out perfect. So I'm not paying the entire contract amount to
Right.
him. I'm just paying him on a monthly basis, and I'm getting reimbursed on a monthly basis.
Is this normal for the bank to do reimbursements rather than lending
Yeah,
money?
they don't give you the money. They're not going to give you all the money for CapEx. They usually reimburse you. They won't pay it up front either.
So the time of when they gave you a third to work on, and then you gave them the invoices, and then the next third and the next third, they don't do that anymore?
Well, it wasn't in thirds. The whole contract was
Well, I got that, but
every month.
the way it used to work is you went and got your approval, and they gave you the first upfront money, and then when you brought all the invoices and everything, they would give you the next amount.
Yeah,
needed.
no.
Not
Now,
anymore.
this doesn't mean that all lenders work the same, right?
Okay.
There could be that program somewhere, but in this case, this is how it worked. So we were prepared for it, and this is how we kind of managed the cash flow to be able to pay the contractor.
Oh, you're right. I understand all that. I'm just asking because that's the way it did work.
Yeah, I mean, every lender could be different. There could be somebody that works that way.
Okay, because we've
But,
heard about this one other time, and I didn't think that was ever done, and now I'm hearing it is more common.
Mhm.
So did any of your renters move into the new renovated units, or did they all leave?
on this project,
Yeah.
most of them left. On the one we're doing right now, most of them are staying and moving into the new units. And I don't know what determines that, but that's kind of how it worked out. And we were able to bring in new tenants at a fairly good pace. So we didn't have an occupancy issue.
And now you're at 100%.
I think last report we're like at 99. I think we have maybe one vacancy.
Okay, well, that's great. Congratulations.
Thank you.
Okay, and what's this other? I can't read my writing, so I can't ask. So I won't ask that question because I
No.
can't read it.
Ask me one that you could read.
No, that was it. That's all the questions I had, actually, till something
Okay.
else comes up. Does anyone else have any questions?
What
Yes,
if we,
good.
Yeah, can you hear me okay?
Now we can, yes.
Okay, I'm in the car, so hopefully you can hear me okay. Yeah, thanks so much for going over your projects and so forth. I'm familiar with construction myself. I had a question. You mentioned like you have a new project coming up. How do you determine the new rents in commercial? As you mentioned, the rental market is decreasing, having some challenges. So I wanted to first find out where you could find that data, and then how are you going to, you know, as your other project comes up, how are you going to, you know, based on that and determine what the rents are and so forth.
Yeah, so what we do is we know the complexes, the building complexes in the area. Our leasing team becomes friends with the leasing teams on the other buildings, even though they don't work for the same management company. So they promote a good relationship. And we have a system, or our management company has a system that they pull the data of what everybody's doing, what the rent is, what the concessions are. So we can end up basically adjusting rent on a weekly basis if we have to. If somebody's giving $500 off move-in special, we have to do the same thing. If somebody drops their rent on a single or one bedroom or two bedroom, we got to do the same thing. So we do what everybody else does. As long as we stay within market, we're able to fill it. And that's and the only problem we're having right now in that 150 unit is that we can't get units renovated fast enough. We are currently renovating. We started with 12 units a month, or 5 weeks, 12 units, 5 weeks. Now we've cracked it up to 16 units every 5 weeks that we're getting renovated. And they are practically pre-leased before we get the batches. So we can't go fast enough. And I know Phoenix has softened rent prices and has occupancy or vacancy increasing, but it's not in every pocket. We just happen to be in a pocket where the total opposite's happening with us. We had no idea it was going to be, I don't want to say easy, but basically they haven't had any difficulty. Part of the reason is that some of the tenants that live there are moving into the new units, but we have enough traffic from the outside that's coming in to fill in the gaps. We bought this building at the end of October. We are now nearly 50% renovated. If we can keep the same tempo, we'll be done by March of next year. 100% renovated and nearly 100% leased. I think it's just the luck of the draw. We're in the right spot in a good area. We have a good product. We have a great leasing team that keeps good pulse on the market and makes those adjustments quick. And we also track traffic comes from on our advertising so that we know where our advertising dollars go.
That's great. Any other question?
no.
Okay, thank you. Cliff?
So a couple of questions. So Danny, what was the average rent prior to renovations, and what's the new average rent post renovations?
On the new building that we're working on? I don't know exact numbers, but it was about 800 going in. 700-800, maybe 750, 775 average rent going in when we bought this building. And our average rent, I want to say somewhere around 1,350, close to 1,400.
Okay.
Now, this was a unique
Really,
deal.
you're creating an entirely different market attraction for this property.
Yes, but basically what happened is that The operators, it's third generation that used to own them. So grandpa built the portfolio. They sold it. Once again, we got it off market. We got lucky that they also carry the paper on it, so we don't have another lender. A plus and minus because we had to raise the money for the renovations. So we have that money sitting in the bank. So we don't have to deal with banks or anything like that. Same contractor, same scenario for him. For us, it's a little bit easier because we have the money for the renovations. And they were mom and pop operations. So at the time when they gave us financial statements, they were on Excel spreadsheets. They didn't even have a system, property management system. They didn't have a website for the building. So we come in and we fix all that. And doing so and being able to put it together, understanding the market, and understanding what the neighbors are doing. Like I said, we just keep tabs of that, and that's how we're able to get the rents that we get.
Very nice. So in Arizona, it's my understanding that cap rates are starting to come up. How is that impacting your exit strategy, and how are you adapting to those changes?
Well, you know how it goes. You make your money when you buy, not when you sell. So the most important part for us is buying at the right basis. We paid for this building $160,000 a door. When we bought it last year across the street, they had bought that building 3 months before we did, and they paid $263,000 a door. So there's the difference, right? It was off market. We got it at a good basis. We were not highly leveraged on it. We're like 55-60% at most leverage. We're increasing the NOI. So when we're done and we have our NOI screaming, we have the option of refinancing. We have a three-year loan with the seller that sold it to us. It's amortizing for the second and third year, and then we have a fourth year option to extend if we needed it. So we build in these safeties because you don't know what the market's going to do. I mean, we see the interest rates increasing right now, which is going to force the cap rates higher. But for us, it doesn't matter because we have a cash flowing building. We'll be able to refinance. We're not forced to sell, and we can just sit and wait basically and operate it, and we'll have distributions for our investors.
So it sounds like it could potentially maybe change your strategy from selling into maybe more of a long-term hold.
Well, we'll hold it as long as we have to.
Okay.
Not to give it, we're not going to give it away. But we know that interest rates have gone up. Eventually, they're going to go down, and that'll give us the exit strategy that we need.
Okay.
It's just a matter of when. We don't know.
And you have to exit, or can you keep holding the property? I mean,
We can keep holding it.
It sounds like you've got a very nice portfolio, and are
We
your
do.
lenders not happy to hold? I mean, not your lenders, your partners, aren't they happy to have that cash flow coming to them every month?
Yeah. Oh yeah, absolutely. And that's across our portfolio. Everything we buy, we're always thinking of the uncertainty of the market at any given point, making sure that the loans that we have can carry us through, basically weather any storm.
And then the cap that you received for your interest rate, that's for 3 years, right?
Yes, currently on that one. On the bigger one, we don't need one because it's a fixed. If it's a fixed, we're fixed at 6% to the seller.
So after the cap, how does that impact your long-term strategy if rates don't come back down on mortgages right now?
We have two options on that. Our 3 years basically expire next October. So we have a little bit less than a year and a half left on that run. If nothing changes and we don't have a window of opportunity, I mean, we may refi. I think that could possibly be, unless the rates really drop and make those cap rates come down again. But we don't know what's going to happen within the next year. So we can refi, take out the bridge, or we can extend the bridge. Because we have 2 one-year options behind that, so a total of 5. So we have options. That's the thing, is we don't know which is going to be the best option yet, but we like to be able to have options in this case.
Okay. Any strategies beyond 5 years?
No, because we probably want to unload it. You know, once we hit the hurdles that we want to hit for our investors is when we sell them. You know, investors want to turn their money quicker. And some of on the Tremazo deal, we have an institutional investor in, and they need to turn that capital. So we'll look for a sale. We'll look for an exit more than a hold if we can find it.
Okay.
Is one of your exits bringing in a different investor so you could get rid of the institutional and hold the property?
Potentially, we've actually talked about that. They're looking to make 1.5 times off their money, which we think we're in that money. We're in that strike zone, but we don't want to get rid of it just yet because we think we can do better for our investors. So we've talked about taking them out. They're not asking us to. Just options. They like the way we operate and partnering with us because we basically told them what we're going to do. We gave them a business plan and we executed on it. So
have you ever thought about just inviting those who want cash flow to come in so you could do very long-term holds? Because they're in it for the cash flow. They're not in it for particularly for the growth, because they will get the growth, right? As rents go up. They'll get the growth as rents grow up. So I'm just thinking all the people that are really looking for cash flow don't really care about growth. They just want money to live on or money that will take care of their children or whatever.
Right. That's harder to do because we have such a diverse group of investors that to be able to hit everybody's desire is hard. Right. So what we do is, you know, we give the cash flow during the hold period. And when you're able to give, and our goal is always to give 2 times multiple back to the investors, that's more than the cash flow they're going to get for the next 2 or 3 years. And that gives them more money to reinvest in other deals. So technically their money can grow faster that way than just getting the cash flow.
If you can find another deal.
You know, that is true. We've bought 2 deals already this year, 2 off-market deals. We want to do 2 more before the end of the year. We have a very active pipeline. And we just, you know, there's no guarantees in you finding another deal, but through the relationships that we have, we seem to be doing okay with that.
So one more question for me on another subject of that. So when you get ready to sell, do you go out and find another property so you can 1031?
If we can, we will do that. But then again, you also have the issue of who wants to stay in and who wants to stay out. So that all depends on how we structure that. I've 1031 a lot of properties that I bought, but I haven't done it as a group because the investors, probably about half of the investors want their money back. And it's just cleaner that way.
That's a lot.
Yeah.
If you had 1 or 2, you could they could go in and then you could buy them out. And then
we can, you know, but when we have a larger group that wants their money back, then it's harder to do.
Got it. Oh yeah, sure, for sure. Okay. Yeah. Francis, do you have a question?
No question. Thank you for asking.
Does anyone have any questions?
Presentation, Danny. Thank you, Danny.
I have a question.
Oh, good. Ask.
What would happen if it went below 80% occupancy? I mean,
If we blew our covenant,
yeah.
well, you know what? I honestly don't know the answer to that. I used to be a banker, and all our loans had loan covenants, different ones because they were working capital lines or acquisition lines. But I would imagine the bank would have been all over us. Why? They'd want to know why. And I would imagine they would want to know what we're going to do to fix it. If it was a small dip for 1 month, Potentially they would say, hey, we dipped, but we're now at over 80. Potentially we'd be okay. But I don't know I don't know what, but I'm sure we'd be talking though, if we did. Right? We've been
Yeah.
talking, but we guarded that very carefully not to drop below that and to have our debt coverage. And right now, I think the banks are very aware of what everybody's debt coverage looks like, because I think they're jittery in some cases with deals potentially going sideways.
Yeah,
So a
that's true.
20% drop, what would that, how many units would that be? Out of
Out
100?
of 88, whatever 20% is of 88,
16 or something.
yeah,
Oh,
maybe
16 or
16 or 17, something like that.
Would that be a huge vacancy rate all at one time?
Well, yeah, if you get that drop under 80%, yeah, you're over 20% vacancy.
Yeah,
No,
but
it's-
what could possibly happen that 16 families would move all out at the same time? That you would-
Well, during the renovations, those were the covenants. We were
Right.
forcing people to move out. So we had to control the amount of people or amounts of units we vacated. Now, your
Right.
question is, what happens if it happens now? Well, if it happens now, that would be really weird. That would be like 2008 in Phoenix. But the triggers that trigger that, everybody would be feeling that, and it wouldn't just be us. We don't have that right now in the market. As long as you have a good product, as long as you advertise it, and as long as you follow up on your leads, there's almost no reason why you can't be above 95%.
Yeah, when you're
Yeah.
all there.
Right? And,
Yeah.
and I mean, the market in Phoenix has softened, and there are some that are under 95%, and we know who they are because we track all that. Our property management company has a database where they actually pull all that information and send us weekly reports. And there are some areas that they struggle a little bit more. Usually these are going to be the rougher areas that'll feel the pain in the beginning when the market softens a little bit, because people will tend to live in the nicer areas or more in the maybe B buildings rather than C or even D buildings.
Yeah. And how far are you actually from the river, or I mean the lake? It used to be a river. Now it's a
Very,
lake.
very close, very close. That's why Tremazo on the lake. That's how the
Yeah.
name came, because it's that close to the lake.
Like a block or two or something.
Yeah, actually really close.
Are you near that bridge with the lights on it? You know, as you see
No, I think that's a little bit down the road.
Oh, okay.
Yeah.
Okay. Right.
Okay. All right, we are at the top of the hour. Is there one last question before we thank Danny? Anybody? Anyone?
Maybe all the questions were answered.
You're pretty thorough.
He is very thorough. He does a great job. So
Yeah.
Danny, thank you very, very much for coming. We really appreciate your brilliance in how you do this. I think that a lot of us who are no longer in that business, thank you, Cliff, for those claps, are good to hear what you are doing. Even though we've been there, done that, you are very organized about it, and we don't hear that. All we hear is they closed on whoever it is, they closed on their multifamily, and then later you hear that they've now got it at 96 or whatever, but you don't hear all the things that they had to go through and the time it took and the money and the ups and the downs and the challenges. So we really, really appreciate what you have brought forth.
Thank
Thank
you.
you.
Thank you for the opportunity.
I'd love you to come back again.
Absolutely. We'll come back with another project.
Oh,
Thank
great.
you.
Thanks. Okay.
Thank you.
All right. Very good. Thank you so much. Wish everybody well.
All right.
You're welcome.